Hey guys, welcome back to a new video. In this video I want to take a look at Williams-Sonoma, ticker symbol WSM. So you can see that the chart is very similar to most other companies where there is a stable part, then this is COVID, then the after COVID pump, and now it has a bit of a collapse. So you can see that it has gone from its high of 202 to 121 right now. So let's take a look at the growth of Williams-Sonoma Inc. So here in the growth section, let's take a look at the profit margin chart, which is very stable. The revenue is very stable. You can see that it's growing year by year. Actually, let's take a look at the revenue growth. So you can see that it's very stable. 7, 5, 2, 4, 7, and it's really starting to pick up in the last years. Pick up in the last years. And the profit margin is also growing, which I like to see. The net income, however, is a little bit less stable. You can see that over the last 3 years it has tripled. So we're going to have to look into whether that is sustainable or not. Looking at the free cash flow margin chart, you can see pretty much the same story with free cash flow, except there's a dip here in the last year, which is something again that we have to investigate. But that's pretty much it for growth. So let's move on to the valuation of Williams-Sonoma. So here in the valuation, let's take a look at this left chart first. So you can see that the revenue is actually bigger than the market cap, and the earnings, well, they're about a 1 to 8 with the market cap, which means that the PE ratio is about 8. Actually, let's take a deeper look into the PE ratio, and you can see that it's going down really fast. And you can see that it's about 7.48 in the last year. However, the 5-year PE is still 12, and that suggests that the company has been growing really fast over the last, 2-3 years. So enterprise value to earnings. I'm not going to go too in depth with this chart because it is a little more complicated, but let's just move on to the price to free cash flow chart. And you can see that the free cash flow here has really dipped, and then the market cap also. So the price to free cash flow ratio has basically stayed the same. So not too much to talk about there. The book value chart. Okay, so it's pretty nice actually, because the book value is stable or growing by a little bit. It's growing not by the most of amounts, but it is growing, and the percentage of current assets is also not the worst, although it is declining, which I don't really like to see. Of course, we want to see a big percentage of current assets because long-term assets aren't as versatile and you can't sell them as fast as current assets. So we as investors value current assets a lot more than long-term assets. So that's pretty much it. Let's move on to the financial health. So here in the financial health, first of all, let's go over the right chart here, because it's way easier. So you can see that in the assets tab, they do have a lot of long-term assets, and they do have a lot of property, plant, and equipment, which I do not like. However, they have a bit of cash actually, and the inventory is pretty big, but it isn't the worst. Of course, they make they make so many products. Sonoma makes so many products that I'm not actually that worried about the big inventory, because they really do sell everything that you would want in the home category. So they basically sell anything that you would want to buy in into your home, right? So the inventory isn't as such a big surprise to me as if Apple had such a big percentage of their inventory, um, right? So let's go to the liabilities. So they do have a lot of long-term debt, and that's basically it. Nothing special about this chart. So let's now move on to the left chart, that one. So the free cash flow is growing, but you can see that it had a pullback, and then the cash also dipped. And I don't know what happened here in 2019. We're going to have to investigate that a bit. So assets and liabilities, assets are growing, liabilities are growing. There's nothing to talk about there, and shares outstanding are falling. Okay, so that's pretty much it. Let's go to the ratios and dividend. Okay, guys, so here we are in the ratios and dividend. You can see here on the left chart that the free cash flow is much bigger than the dividend payout ratio. And the 5-year dividend payout ratio is actually smaller than the current dividend payout ratio, which is not too great. I usually want to see a decrease in the payout ratio. But here it's fine, as the dividend payout ratio is only about 33%. On the right chart here, you can see the ROA and ROIC chart, which I love because the ROIC is very big. It's actually 45, 40, and even here in the worst possible scenario, at the worst possible point, you can see that the ROIC is still 11.6%, which is not too bad. I want to see it around 12 or above that. And ROA, I want to see over 10%, so still fine. And this increase is mostly because of the increase in earnings, right? So that's actually, oh, they do pay a dividend. I thought they don't. So they actually do. Oh yeah, of course they pay a dividend. What am I talking about? Okay, so the dividend is not too great, too big, but they do have a great payout ratio. Um, so yeah, I think it's fine. Like, there's nothing to talk about here. I mean, it's very nice. So here in the forecast, you can see the margin estimates are actually very good, um, especially because the margin went up from 5 to 10%, 13, pardon, and then now it's supposed to go like basically nowhere, just be stabilized from here, right? So I don't think that's gonna happen. I think that analysts are overly positive about the situation, especially because, like, look at this growth. Like, companies don't really go from 5 to 13% profit margin in 2 years, right? Um, but anyway, so earnings are fine, and then revenue also um, is predicted to continue growing. But the fact that the company just grew, if I change back to earnings again, the fact that the company just grew from 350 to 1090 in 2 years, I think that that's not sustainable, and I don't think this is what is going to happen. I think they're going to have a big pullback because this is a company that got a lot of cash from the COVID um, incident, or whatever you want to call it, right? Because this is their normal earnings, right? And then when COVID came, everybody started ordering stuff into their home because, of course, what will you do? You're bored, you got money from the government, So you're gonna go order a new chair or a new whatever it is from Williams Sonoma, and then that's the result of that. I actually think they're going to pull back at least a little before continuing to grow at that stable rate again. But yeah, that's definitely something that we're going to have to remember when doing the intrinsic value calculation, which we're going to perform right now. So if we go to the summary and intrinsic value calculator, I'm actually going to put, this is for the next 10 years, which means I'm going to do 0, 2, and 4. And for the profit margin, I'm going to actually keep it as is, because this spreadsheet does provide me with some initial values for the profit margin and free cash flow margin, because it basically derives it from the profit margin that is right there. And then the PE and price to free cash flow, I am going to lower a tiny pinch. I'm going to say 11, 14, 17. Maybe 13, 13, and 16. Sorry, 15. That's how it is. And the rest I'm going to leave as is. So you can see that although it is actually, although you can see that it is actually almost all in the green, you can see that the current price is 118, and that the low estimates are just barely in the red, actually. I think that this company is very undervalued. You can see that we severely lowered the revenue growth, especially if you consider what has happened in the last 5 years, right? And it's still in the green, so I think that this company is a little bit risky, but I think the risk is worth it, because, again, this is not such a easy to beat business, right? This business does have a moat, and it's not that bad of a business, right? They do sell their home products, right? And they do sell them consistently. Their revenue is growing. Everything is fine. So I do think I'm going to add this to my watch list at this medium price here. So I already have it in my watch list, but I want to replace it anyway. And guys, I'm working on this spreadsheet currently. It's a very cool spreadsheet, but I'm trying to make it a website. So if you do appreciate that, then please do subscribe and smash the like button. And I hope you enjoyed, and I'm going to see you next time.